Welcome to the Deep Dive. Today we're getting into the nuts and bolts of a major player in Indian agriculture and construction, Escorts Kubota Ltd.
That's right. We've got their latest numbers, Q4 FY25, and the full fiscal year hot off the press from their May 8th filings and presentation.
And our mission, as always, is to cut through the noise, pull out the key figures, and really understand what's going on with their performance.
Exactly. We're using the official sources, the audited results, the auditor's reports, their own earnings deck. No spin, just the data.
Okay, so let's start high level. What are the immediate takeaways, the headline figures for Q4?
All right, so standalone Q4 revenue from operations was 2,430.3 crore.
Okay.
And profit after tax, this includes their discontinued operations, came in at 2,497.5 crore.
Got it. And the consolidated picture for Q4?
Very similar story, slightly higher. Consolidated revenue at 2,444.9 crore and net profit 318.42 crore.
So how do those stack up?
Yeah.
Compared to, say, last year or last quarter?
That's where it gets interesting. There's definitely a bit of a mixed signal here. Well, compared to the same quarter last year, things look pretty good. Standalone revenue is up 6.1% year-on-year. Profits up 8.2%.
That sounds positive.
It is. But compare it to the previous quarter, Q3, and you see a drop. Revenue down 17.2%. Profit down 7.9% quarter-on-quarter.
Okay. So growth year over year, but a slowdown sequentially.
Exactly. And the consolidated numbers basically echo that trend. Revenue up 6.3% year-on-year, but down 17.1% quarter-on-quarter.
And profit.
Consolidated net profit actually quite strong year-on-year, up 17.9%, but still down slightly, just 0.7% compared to Q3. So yeah, definite shifts in momentum there.
Okay, let's dig into that standalone performance for Q4 then. You mentioned the overall revenue, 2,430.3 crore. What about the segments? Agri-machinery.
Right, that's a big one for them. Agri-machinery pulled in 1,974.8 crore in Q4.
And how does that compare?
That's up a solid 11.1% compared to Q4 last year.
Okay.
But again, following that pattern, it's down 18.3% from Q3.
And what about tractor volumes within that?
Yeah, they sold 26,633 tractors in Q4. That volume is up 7.6% year-on-year. But it's down 18.2% compared to the previous quarter. Same volume number, interestingly enough.
So more tractors than last year's Q4, but significantly fewer than last quarter's Q3. What could be driving that kind of swing? Seasonality.
Yeah, that's the big question, isn't it? The year-on-year rise suggests, maybe better underlying demand or market conditions compared to a year ago.
Right.
But that sharp sequential drop, yeah, could be seasonality, like you said. Harvest winding down, perhaps.
Yeah.
Or maybe shifts in financing availability for farmers.
Something to watch then. Is it just the usual cycle or something more?
Definitely one to keep an eye on.
Now, what about the other big segment, construction equipment in Q4?
That's, well, a bit of a different story. Revenue there was 453.88 crore.
And the trend?
Down 12.2% compared to last year, and also down 13.6% compared to Q3.
And unit sales?
They sold 1,719 units in the quarter. So yeah, unlike Agri, which had that YoY revenue growth, construction is contracting on both fronts.
That suggests maybe a tougher market for construction equipment specifically during that period?
It could well be. Could be a slowdown in infrastructure spending hitting them, or other specific challenges in that sector, raises questions about the overall market health there.
Okay, let's pivot to profitability for standalone Q4. Profit before tax and exceptional items.
That was 358.3 crore, up 9.7% year-on-year.
A down Q, yeah.
Yep, down 5.7% quarter-on-quarter, follows the revenue trend.
And profit after tax, including the discontinued ops.
297.5 crore, again up year-on-year by 8.2%, but down 7.9% from Q3.
And the EPS, the earnings per share.
Basic EPS, covering both continuing and discontinued operations, was 27.05. That's up 8% YoY and down 8% QoQ. Very consistent pattern.
Right. Then there's EBITDA earnings before interest, taxes, depreciation, amortization.
EBITDA stood at euro 292.9 crore. That's barely up year-on-year, just 0.7%. And quite a drop from Q3, down 12.6%.
And the EBITDA margin. The profitability percentage.
The margin was 12.1% for Q4. Now, this is interesting. It was down 66 basis points compared to last year.
So slightly less profitable per rupee of revenue than last year.
Correct. But it was actually up 63 basis points compared to Q3.
Okay. So profitability improved a bit from the immediately preceding quarter, even though revenue fell.
Exactly. It suggests maybe some cost control kicked in during Q4, or perhaps a slightly better product mix compared to Q3, even with lower overall sales. It's a nuanced picture.
It really is. Okay, let's zoom out. The full year, FY25, standalone highlights, revenue from operations.
For the full year, 10,187.0 crore. That's up 4.7% over FY24. So positive growth for the year overall.
And tractor volumes for the full year.
Totaled 115,554 units. Just a slight increase, up 1.0% year on year.
Okay, only 1%. But how did the market do overall?
Now that's where it gets really interesting. The overall domestic tractor market in India grew by 7.3%.
Right, healthy growth.
But Escorts Kubota's domestic volume growth was only 1.6%.
Oh, so they significantly underperformed the market.
Yeah.
Like by negative 5.7% variance.
Precisely. They lost ground relative to the overall domestic market growth.
And exports.
Even tougher story there. Their export tractor volumes actually declined by 11.2% year on year.
Well, the overall export market.
The overall export market for tractors grew by 1.0%. So again, significant underperformance.
Wow. So even though they sold slightly more tractors overall for the year, it seems they lost market share both domestically and internationally.
That's the takeaway, yes. It definitely raises questions about competitiveness, pricing, maybe even product gaps compared to the competition. Why couldn't they capture more of that market growth?
And what about construction equipment volumes for the full year, FY25?
Those came in at 6,484 units. That's down 9.2% compared to the previous year.
Okay, down 9.2%. How did their market segment do?
The overall market they serve actually grew slightly by 0.9%.
So another significant underperformance. A negative 10.1% variance there.
Yes, another substantial miss compared to the market trend.
Any specifics within construction? Like backhoe loaders?
Yeah, they break it down. Backhoe loader volumes, which are pretty key for them, dropped a hefty 17.5%.
Ouch. And the industry for backhoes?
The industry actually grew by 3.4%.
Wow. Okay, what else? Compactors?
Even worse there. Compactor volume plummeted 29.2% for Escorts Kubota.
Against industry growth of?
Industry growth of 4.3%.
Yikes. Any bright spots? Mini excavator.
A slightly less dim spot, perhaps. Their mini excavator volume declined 4.2%.
Which was?
Actually better than the overall industry for minis, which declined 7.7%. So they outperformed the market decline there, but still a decline.
Right. So overall, a really tough year for their construction equipment business in terms of volume and market share.
Absolutely. Significant headwinds, major volume drops in key products while the market often grew. It paints a clear picture of challenges in that segment during FY25.
Okay, let's look at the profit side for the full year. Standalone FY25. Profit after tax.
That was 12,250.9 crore, which is actually a healthy jump, up 15.7% compared to FY24.
Okay, so profit growth was strong despite the volume challenges in construction and market share issues in tractors.
Yes, which is interesting. The EPS followed suit, 113.77, up 19% year on year.
And EBITDA for the full year.
Came in at euro 11,177.8 crore. That's up 4.0% year on year.
But the EBITDA margin?
The margin dipped slightly, came in at 11.6%, which is down 8 basis points compared to the previous year.
So they made more profit overall, but the profitability on each rupee of revenues slipped just a tiny bit for the full year.
Correct. It suggests that maybe cost pressures or pricing dynamics offset some of the revenue growth impact on the margin. They grew the bottom line nicely, but core operating efficiency per sale saw a marginal dip.
Let's get into the segment specifics for the full year, standalone again. Agri-machinery revenue.
That was 8,447.2 crore, up 7.0% year on year.
And the profit margin for agri, the EBIT margin.
EBIT margin was 10.7%. That's down 50 basis points, or 0.5% compared to last year.
So margin pressure in the core tractor business despite revenue growth.
Seems like it. Could be input costs, competition, you know. They also mentioned having about 1,600 exclusive dealers in India.
There's a big network.
Huge network. And an interesting stat for Q4. The sales ratio of smaller tractors, less than 40 horsepower versus bigger ones, over 40 horsepower, was 33 to 67.
So 2/3 of sales in Q4 were the larger, more powerful tractors.
Yeah, suggests a continued preference for higher HP models, at least in that last quarter.
Okay, now construction equipment standalone for FY25. Revenue.
Revenue was 1,730.09 crore. That was up just slightly, 0.7% year-on-year. Pretty flat.
Okay, flat revenue despite those big volume drops we discussed.
Exactly. But here's the flip side. The EBIT margin for construction was 9.9%.
And how does that compare?
That's up significantly by 75 basis points year-on-year.
Huh. So they sold fewer machines, revenue was flat, but they made more profit on each machine sold.
That's what it looks like. Maybe they focused on higher margin products within the segment, or achieved better cost control, or perhaps pricing held up well despite lower volumes. It's an interesting dynamic.
It really shows you can't just look at volume, can you?
Absolutely not. Profitability per unit matters hugely.
And before we jump to consolidated, anything on dividends?
Yes, good point. The board recommended a final dividend of 18 per share.
Which brings the total for FY25 to
28 per share for the full year. Important info for investors, definitely.
Okay, let's shift gears slightly to the consolidated view of the whole group, including subsidiaries. Q4 FY25 revenue.
Consolidated revenue from operations 2,444.9 crore.
Which is up 6.3% YoY, down 17.1% QoQ. Looks very similar to the standalone trends.
It does. As you'd expect, the standalone business is the lion's share, so the consolidated figures usually track pretty closely.
Makes sense. What about consolidated profitability in Q4? Profit before tax, excluding exceptional items.
That was 352.6 crore, up 9.9% year-on-year, down 6.5% quarter-on-quarter.
And profit after tax, including discontinued ops.
318.4 crore. Strong growth year-on-year, up 17.9%, but again, that slight dip from Q3, down 0.7%.
EPS, similar.
Yep, same pattern.
Consolidated EBITDA for Q4.
287.5 crore, up just 0.7%. YoY, down 13.6% QoQ.
And the consolidated EBITDA margin.
11.8%. Down 65 basis points YoY, but up 48 basis points QoQ. So again, the same patterns we saw in standalone are pretty much mirrored here.
Okay, no major surprises there. It reinforces that picture of YoA growth, but a Q4 slowdown.
Exactly. It gives you confidence that the trends we dissected in the standalone results are representative of the group's overall performance in the quarter.
And quickly, the full FY25 consolidated highlights.
Revenue.
Full year consolidated revenue, 10,243.9 crore, up 4.5% year-on-year.
Profit after tax.
12,265.0 crore. That's a strong 17.5% increase year-on-year.
EPS.
115.04, up 17.3%.
And full year consolidated EBITDA and margin.
EBITDA was 11,165.3 crore, up 3.2%. The margin was 11.4%, down 27 basis points year-on-year. So again, same underlying story. Decent full year profit growth, slight squeeze on the overall group margin.
That's the summary, yes. Consistency across both views.
Now, besides the core numbers, there were some pretty significant strategic things happening, weren't there? Like the amalgamation.
Oh, absolutely. That's a crucial piece of context. These results, both current and the prior year comparison figures, have been restated.
Why?
To reflect the merger, the amalgamation, of Escorts Kubota India Private Ltd and Kubota Agricultural Machinery India Private Ltd. That officially became effective from April 1st, 2023.
So the comparisons we've been making year on year are already adjusted for that merger.
Correct. The NCLT, the Law Tribunal, approved it back in August 2024, but it's effective retrospectively from the start of FY24 for accounting. It means we are comparing the combined entity's performance year over year.
Okay, that's important for understanding the baseline. What else? The railway business.
Yes. The big one. They're selling off the railway equipment business, or RAD.
Selling it to whom?
To Sona BLW Precision Forgings Limited, often known as Sona Comstar.
Right. And the price tag?
A pretty substantial 1,600 crore lump sum payment.
Wow. When does that happen?
It was approved back in October 2024, and they expect to complete the transfer by June 1st, 2025. So quite soon after these results.
And this RED business, was it significant? Did it have orders?
Oh, yes. As of the end of March 2025, its order book was around 900 crore. That's excluding some specific orders temporarily on hold.
So a decent backlog. And how did it perform financially, this business they're selling?
Well, in Q4 FY25 alone, it generated 256.62 crore in total income and 46.80 crore in profit after tax.
And for the full year FY25?
Full year income was 913.11 crore and profit after tax was 140.89 crore.
So it was a profitable, sizable business they chose to divest.
Absolutely. It wasn't like they were dumping a loss maker. This looks like a very deliberate strategic shift to presumably focus more intensely on their core areas, agri and construction.
In a sense, freeing up capital and management attention.
Precisely. That Euro 1,000 crore influx will also be significant.
Anything else on the strategic front? Asset sales.
Yes. Relatedly, they also agreed to sell some land and a building in Faridabad, also to Sona Comstar, 410 crores. That was approved in February 2025.
So Sona Comstar is buying the RED business and some property.
Seems that way. These assets are now classified as held for sale.
And were there any exceptional items affecting the profit numbers?
Yes, small ones. A charge of about 27 crore in the standalone results and about 1.7 crore consolidated.
What was that for?
It was an impairment, basically a write-down, of their investment in a joint venture called Adico Escorts Agri Equipment Private Limited. They cited sustained operational challenges there.
Okay, so tidying up some balance sheet items as well.
Looks like it. Part of the broader realignment.
Okay, so let's try and pull all this together. How would you summarize the overall picture from these results? It feels quite mixed.
I think mixed is the right word. You've got clear positives, especially the year-on-year growth in overall revenue and particularly profit after tax for the full year.
Right.
But then you have these counterpoints. The quarter-on-quarter slowdown is quite noticeable, especially in Q4 revenue.
And the segment performance was patchy.
Very patchy. Construction equipment volumes took a real hit, and the tractor business, while growing slightly in volume overall, lost significant ground relative to the market. That's a concern you'd have to flag.
And layered on top of this performance picture are these major strategic shifts.
Huge shifts. The Kubota amalgamation is now fully baked into the numbers, shaping that baseline. And the divestment of the railway business is a fundamental reshaping of the company's profile going forward.
So it really signals a sharpening of focus, doesn't it?
It absolutely does. Exiting R&Z means agri-machinery and construction equipment become even more central to their identity and future.
Which means what management says next becomes crucial.
Exactly. You'll want to pay close attention to their commentary around FY26 strategy. How are they planning to tackle that market share issue in tractors? What's the outlook for rural demand? How is the Kubota integration progressing beyond just the financials?
Right. The execution story.
That's what it comes down to now.
Okay, so maybe a final thought for you, our listener, to chew on. When you consider everything we've discussed, the mixed financial results, the market share slips, but also these big strategic moves like the Kubota integration and selling the railway division.
Yeah, what does this all suggest about Escorts Kubota's position now? How are they set up for future growth and profitability in what's still a very competitive Indian market?
And maybe what are the longer-term implications of ditching that railway business? Was it the right move to double down on agri and construction?
Those are the key questions, aren't they? How effectively will they deploy that capital from the sale?
Yeah.
Can they leverage the Kubota synergies to regain momentum? Will the focus strategy pay off? Lots to watch.
Definitely. Well, that wraps up our deep dive into Escorts Kubota's Q4 and FY25 results.
We hope this breakdown gave you a clearer view of the key numbers and the strategic context surrounding them.
As always, we definitely encourage you, if you're interested, to look at the source documents themselves. The full reports and presentation have even more detail.
And do let us know if you have any follow-up thoughts or questions. We're always interested in hearing different perspectives.
Join us next time on The Deep Dive. Until then, keep digging deeper.